Hello fellow freedom builders out there, my name is Hans and I'm back with yet another Stock of the Week video here from Building Freedom. Today we're going to look at a little gem I have found for you, or maybe little is not the right word because it's actually quite a big stock, but it's not one of the mainstream stocks that is talked about all over Facebook and so on. The name is Synnex, and I can't say right away that I am pretty interested in buying some of it, but I have a couple of concerns that I will share with you in this video, and if you stay tuned to the end of the video, I can tell you where I think it is going to go. I can spoil it now and say I think it's going up, but as I said, there are a couple of details you need to know. I'll fill you in through the video here. Okay. First of all, we're looking at the chart, and if you have seen my video, I have made the first video in the series called Learn My Strategy, and in that video I tell you about this CRS, Comparative Relative Strength Indicator, that pretty much shows if the stock is going up faster than the overall market. And as you might have seen right now, we are in mid-January 2020 when I make this video, and the market is going up quickly. So it is important to find stocks that are going up faster than the market, because we want stocks that outperform the market. This one does, and as we can see on the RSI, it is above 50, so everything is green here. This is in my green zone in my trend schedule. So this is great. We can go on. The technical analysis checks out. I'll get back to this later. But let's have a look at what Synnex is actually doing, and it is a company that provides services to in the IT sector. As you can see here, it might be a bit. Here we go. I just had to make my screen fit here. As you can see, they are pretty much two companies in one here. There's the technology solution, and there is the Concentrix. However, as I will get back to, the Concentrix they're actually starting to split it up, and they are planning on doing that here in 2020. So we will end up with two separate companies on the stock exchange, but the ones owning stocks right now are giving an equal amount so that it all adds up. So we'll just, if we own the stock, end up with two different stocks, one called Technology Solution and one called Concentrix. Right now it's just called Synnex. It started in 1980, and they are providing a lot of different services, both physical products to your computer, but also a lot of cloud-based, server-based services. If you want to learn more about them, you can dive into all the here on the website under About Us. You can see the overview and you can see a lot of it. With companies like this, with many thousand employees and a lot of different sub-products, it would take me an hour to cover it all. But as you can see, they distribute more than 30,000 technology products, and yeah, they are a reseller of a lot of physical products as well. They have been busy growing, and if we look at the history here, you can't see, and we can see that in the fundamental numbers just in a second, because we can see that they have acquired a ton of different companies. As you can see, IBM Customer Care Business, Synnex, Tiger Spark, Westcon Comstor, so on and so on. There are some well-known names in here, and they have bought up and bought up and bought up, and now they are kind of splitting up. They just ended the 2018 acquisition of Convergys here, so now they are splitting up, as I mentioned a second ago. But as we will see in the numbers, they are taking on some debt due to all of these acquisitions here, and that might be one of the concerns I'm having here. Basically, just to mention the split-off, you can see here, I'm in Yahoo Finance, the Concentrix spin-off just unlocked some significant value for Synnex. I am not an expert in saying if this splitting the company up is perfect. So I am relying on a lot of analysts on the internet from all of the big houses, and they are also all of them pretty much are agreeing that this splitting the company up is the completely right thing to do. So I'm leaning on them, and I'm not diving into that any further. Let's have a look at some of the numbers. We have Synnex here, and as you know from Stockopedia here, which has become my number one favorite tool when looking at the company numbers. It is simply so easy to get a grasp of the numbers. I'll put a link to it below. They have a free trial, you can test it out for yourself. The quality 95 on a scale from 0 to 99. They have a value. I'm actually not normally looking too much at the value, but here 73 in value, that's great. Momentum is 99. And that is not just momentum, as you might remember. It's not just price momentum, but also are there coming some good news? Are they having positive surprises in compared to the estimates and so on? So this is a complete number for that. And then the overall stock rank is 99, which is absolutely great. Let's dive a bit into that. As you can see, PE ratio of 10.7. I'm not looking too much at PE ratio because honestly, I don't feel it tells me very much. As you know, I do like the PEG ratio. I do like that to be below 2. That is the current PE ratio divided by estimated earnings per share growth. And that is giving 0.5, which is great. Earnings per share growth, by the way, 25.5% is great. However, if you are a dividend investor, this might not be the stock for you. They do pay dividend, but as you will see in a second, they have actually cut that down quite a lot. And that is to get a bit of control of the liquidity of the company, I guess. Price to book value is not extremely high, 2.0. And the thing I do look at more than I do look at PE ratio is actually the enterprise value to EBITDA. I'll make a separate video about this single one here because that is actually pretty important. But 8.8 is great, and as you can see, compared to the industry and the market, they are doing very well here. Price to sales I also like because that is hard to manipulate. Having that one below 1 is absolutely phenomenal. You can see return on capital, return on equity are great. Operating margin is not the best, but however, it is okay compared to the industry. If you look down here, we can see, and that is one of the complaint points I have here, the operating cash flow and free cash flow has not developed the way I like it to be. I like that to be fairly high and rising. So right now they are actually in lack of free liquidity, and that is something that concerns me a little bit. As we can see, the dividend history has been absolutely great. It started with 12.5 cents, then 57.5, 85 cents, $1.05, $1.40, $1.50, and then boom, cut it in half down to 80 cents. And I'm pretty sure that that is one of many measures they're taking to get this free cash flow under control. Also, you can see that their net debt has been rising quite heavily, and that is of course due to the acquisitions they are making. They do have an interest coverage of almost 5, so it's actually okay. They can pay the interest on the debt, but I do like to see some more free cash flow to actually invest in new things. All right, you can see the sales growth is great. The earnings per share growth is great. Also on the 3-year time scale here. If we look down here, we can see that the analysts there are 10 brokers covering this, and they are all at a strong buy now, and they were at a strong buy 3 months ago, and they are upgrading their expectations to the earnings per share here in 2020 and 2021. You can see these numbers here as well. So basically, this is a very solid stock with a couple of small spots here, and that is the free cash flow and the operating cash flow. I don't like that, and they are also taking on a bit more debt than I actually like. But that said, I really like what I see here. You can also see that Stockopedia is putting the stocks into different categories, and you can see, of course, it is technology. It is what is called balanced, it is a large cap, and it is what they call a super stock. And super stocks tend to outperform the rest of the pack. So that is great here as well. All right, let's have a look at the price compared to the fundamentals. And you know, I like to see that. We can just start zooming out here, and you can see that it has been a business where the adjusted earnings, operating earnings have just gone up. They started paying dividends here in 2014, and they have been rising, but now, as I mentioned, they are cutting. Maybe it's not forever, and they're not removing dividend altogether. So that might be a signal to investors that this is just temporarily. All right, but what you can see here is that the price has followed, at least the blue here, the normalized PE ratio of around 11.5. It has followed that fairly well, and it has actually a lot of the time been up here around the earnings line as well. If we zoom a bit in, on the 10-year scale, you can see that as well. The two lines have followed each other quite nicely, and then here from 17, it really took a big hit, and I think that was with the last acquisition. People were really doubting if that was the right thing to do. But if we can find a good stock where we like the fundamentals, and we can see the price coming from this really undervalued zone down here, and then moving up towards an area up here, I think we are in a really great zone. We can look at the 5 years as well. You can see over the last 10 years we've had a yearly growth rate here at around 14.5%, and on a 5-year scale that drops a bit, but still we can see we are around the PE line here of 10.7, but with some room up to the adjusted earnings line. So let's have a look at the forecasting here. If we look at the estimates, let's just remove this one. As you can see, we are around here just above the 10.5 PE line. If we were to move up towards the area where we can see the adjusted earnings are, we could move up to a PE around 15. And if they did that very quickly, we could see a rise in price of 38%. Also, it could take 2 years, so that would be an annual 22%, and that is included the small dividends. Also, of course, it could be that we were going up quicker and we would be making more money. However, these analyst predictions are made from some fairly small changes in the earnings, and I'm pretty sure that they are not including the new unlocking of the potentials when they are splitting the company up. But let's just say that this is the right numbers, and let's say that it is staying at 10.5, and we are actually staying at this point, maybe even dropping a bit in price. We could lose a couple of percent the next year. It could also be 13% if we just were rising slightly. But if we are putting in some of our own numbers and saying we actually think that they could grow maybe 7% per year because of this new splitting the company up, then we have a completely different scenario here. If we were to aim for the earnings line up here, we would be making 26% per year, and I actually have a feeling that within a couple of years we could move up somewhere between $200 and $250 instead of this around 150 where we are at now. So this is actually making me very comfortable. It is pretty much what I like to see here. A pretty controlled downside and a great upside. If we're looking at the SAC platform, we can see that it actually has a SAC rank of 1, which is not many companies that have that. That pretty much means that SACs, they have this algorithm where they can see if the estimates is going up, if are they making positive surprises and so on. And you know that the things I like to see in here, pretty much we can find it down here. We have the broker recommendations. Let's see if I can find that. Broker recommendation, it's coming here. The funny thing is, I mentioned it before, that when the broker recommendations really start to go up, that is, or down for that matter, it is pretty much a good picture of the the next 6 to 12 months of price. And what you can see here, it dropped a bit, and let me just see here, we can just scroll it. Then it went sharply up, and we're at the highest level it could be at 1. That means that all analysts are saying strong buy. And it did that here in September 18, and that is pretty much where it bottomed out. And it has gone from around 75 and then doubled since then. So right now it is at a 1 and it is staying there, and the analysts are very, very much in line with each other. We can also see that the price and earnings per share surprises, we can see that here. It is a bit slow, Synnex, sometimes, but here it comes. As you can see, they have, the last time they had a negative earnings surprise was in 2015. So they have just been making positive surprises every single time since then. So that is very good, and they came out with a new positive earnings surprise here the other day. Well, we can't see it now, but it doesn't matter. It is positive with, I think it was 15 or 18% off. So Synnex are saying, yes, just buy this one. It is a safe buy. Let's have a look at a bit of a shorter time frame here. Let's have a look at the Synnex Corp here. Yeah. The Synnex Corp in tip ranks is scoring a 10 out of 10, and that is pretty much what we like to see. The analysts are saying a strong buy. If you're looking at that, they are aiming at, we can see here, 4 months ago, I'm not really interested in that, but the last 7 days, we can see that it is a buy from some fairly good ranking analysts here. They're saying somewhere between 150 and 175, but that is probably before this jump up, I'm pretty sure. So they were down here at 125, 127. Then the earnings were better. I'm not sure why they're saying minus here, but that was a positive earnings surprise here. And then this news came with the splitting up of the stock. So that jumped up pretty quickly, and I'm pretty sure that within the next week we'll get some more analysts saying that it should go up further. Of course, we could take a lot of other ranking analysts in here, but I am mainly focused on the best of them. If you're looking at the other scores here, blogger opinion bullish, hedge fund bullish, the insiders have sold some shares, but when we're looking at who that is, we're not interested in the lower ranking officers in the company. We're looking at the higher ranks, and that is pretty much just the CEO, Dennis Pollock. And for the last 3 months, he have sold out for something like $300,000. That is not, maybe it sounds like a lot, but for a CEO in a multi-billion-dollar company, this is peanuts, absolutely. So I'm not concerned about that at all. Tip ranks investors positive news sentiments, that can be a good one just to have a look at. And in here we pretty much see what I also mentioned. We can see here news sentiment for the last 7 days, very positive, 100% bullish. And that is pretty much these concentric spin-off and so on that the articles are talking about. So all in all, it is a 10 out of 10. Normally, I don't like that being below 6 or 7 or something like that. I do like the shorter term momentum in media, in bloggers, in analysts to be positive. When we look at the Guru Focus, as you know, they have these warning signs, and I like to see if there are some severe warning signs at a company, and there are 2 here. One is the long-term debt. They say Synnex Corp keeps issuing new debt. Over the last 3 years, it issued $1.8 billion of debt. And we know that already, and that is for all the acquisitions, and that is one of the reasons why the price dropped for a while. The asset growth faster than revenue growth. It says here, if a company builds assets of around 25% per year, which they do, faster than its revenue growth rate of around 10% over the last 5 years, it means that the company might be getting less efficient. And I think we should look back here and see, when you are acquiring so many huge companies into your organization, of course the assets will grow, but it will be next to impossible to keep up the margins. You have to include these companies, and that take time. So the warning signs here is not something I'm really concerned about. Operating margin is going up, all right. Medium warning signs, revenue per share is declining, okay. Dividend yield, we know that one. Price and PS ratio, I'm not looking too much at these. It is close to a 3-year high, the price to sale ratio, but it's still only a 0.32, so nothing really to be concerned about there. All right, so what is the final verdict? Let's just have a look at the chart once again, and let me go over to the weekly chart only. What we can see here is that Synnex has been quite a wild story. It has gone up from down in the 20s and up to, it has up 7-fold here in just 6 years or so. It has been a very, very nice investment. However, it broke down here and went from 140 down to, well, pretty much cut in half. And then it started to grow from there. As you can see, I've drawn in 2 different trend channels here. One of them is what is called a parallel channel. If you're using TradingView, you find it over here. Normally that one looks like that. You press that little button here, and you can choose the parallel channel, and that pretty much just let you drag and drop such a channel here. So if you take manually and draw a channel, that would be somewhere like here. Oh, sorry, like this. And we got a break up through this channel here in September 19. However, I'm not too fond of making these channels myself, because there can be a lot of subjectivity put into that, so I'm not completely neutral. So I tend to use my regression channel instead. And as I mentioned before, I will make a video about that one, but that is also in this menu here down at the regression trend. And what that does is that it draws a regression line through the prices. It is a statistical concept where it makes the best middle line that covers the most data points, and then it takes a couple of standard deviations on each side. That tells me that when we break out of a channel like this, it is a statistical significant move. We can try and draw one here as well, from down here at the bottom somewhere here, and draw it. Oh, sorry, that was the wrong channel. We'll just take the regression channel here, like this. And you can see that this was a very, very nice channel with only a few touches on the outer limits here. And when it broke down, we could have gotten out around 100 and 105, and then it took down to around 70. But now it has broken up. It has broken the recent top here. And what I am looking for now is, you could look to buy here, but what I do like when we see a clear top like this is broken, I do like to see some sort of a little retracement and then some show of strength here. So what I will probably do is that I will get in around 140, 142 or something like that when it just drops a bit. Of course, I can't be so unfortunate that it just keeps going up, and then I'll have to reevaluate the scenario. But right now, it is a very strong stock. And I know some of you, if you are a hardcore value investors, then you would say that it has gone up too much. It is not real value anymore. But that is where I kind of mix the different styles, because I do like to see that it is value, as you know from the fast graphs here. I do like to see that there is some upside before people starts to think that it is way too expensive. But I also want to see a trend. So I'm also a trend follower in stocks that starts from a low point. And when you are a trend follower, you just have to get a grasp of the concept that you are never getting in right at the bottom. You're never getting in down here. You are only buying stocks that has also already run for a while. And you might say, yeah, well, it jumped here 88%, Hans. Isn't that, hasn't it gone up too much? Well, if we take a look at this movement down here, you might have set the same. 88% would have been here, and you might have gone in around 30 and gone out around 55, and then you would have missed this entire next 300%. So I'm not at all concerned. As long as I like the stock, I like the fundamentals, I like the qualitative and the quantitative fundamentals around the company, and I see a strong trend where I am in green zone. I can break the former highs here. If I get a little retracement, I have no problem getting into a stock that is up 50 or 100%, because I know that that there's not really any limit as to where stocks can go. And what I showed you just a second before, where I said I thought it could go up in this area, that would be reasonable, also compared to value. Then we are up talking about somewhere around 25-28% per year over the next couple of years, and that would send us up around the 250 level. So I would not be surprised if at this point we could see some sort, of course with some fluctuations, so don't expect it to go up in a straight line, but let's say we get in here around 140. I would not be surprised if we could see some sort of channel up here where it started to move over the next couple of years, and I would be completely satisfied making somewhere between 20 and 30% per year on this, and that is a price, of course, and it is dividends. So it might be a bit lower than 250, but then it might have paid out some dividends. However, the dividends are only small here, so I have a feeling that those of you that are real true dividend investors, you would not really be going for this, not yet anyway. I do like the dividends, but it is not a 100% killer for the deal from my part if they are not paying out dividends. I do like growth stocks as well, so I am mixing the fundamentals, the dividend, the technical analysis all into one big muddy poll here. So I hope this made sense. I can tell you that I will be watching it, and on my on the Facebook site Building Freedom, I think I will keep you updated if I buy that, as long as well as with the other stocks I talk about here. Just remember, I am not a financial advisor. You should do your own homework. This is only for inspiration purpose and educational purpose, and from the feedback I get from you, I can hear that a lot of you are getting a lot out of these videos, so that is great. If you haven't done it already, please like the channel, like the video, subscribe, hit the bell notification, all that you can hit down there below the video. I'm putting links to different to the Stockopedia and to some videos down here, so that you can click directly in there. I will get back to you soon. I have 3 videos planned for you next week, so I'm looking forward to talking to you again soon. Take care of your money out there. Talk to you soon. Bye.